let's get right to it. Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting straight through all the market noise. Today, we are putting Shopify under the forge, under the microscope. Their Q4 2025 earnings report just hit the wire, and, well, the market's reaction was, let's just call it interesting. We're going to tear this report down to the studs, piece by piece, and figure out what is really going on under the hood. There's no hype here, just the hard numbers and the unvarnished truth. Let's start the drill down.
Yeah, because this is the single biggest question, isn't it? You've got a company that comes out with what looks, for all the world, like a blockbuster report. I mean, we are talking record-setting revenue, cash flow that's just gushing out of the business like a fire hose. On paper, this thing is an absolute monster of a home run. So what happens? Wall Street turns around and sells it off. The stock just takes a complete nosedive. It makes absolutely zero sense on the surface. So you have to ask the simple question, what in the world did the market see that the headline numbers are trying to hide? Are we looking at a financial fortress here, or is there some kind of deep structural weakness that we all need to be worried about?
That's the heart of it. You just nailed the central paradox of this entire earnings release. On one hand, you look at the surface, and the numbers, they look like a fortress. The walls are high, the growth is immense, it looks unbreachable. But the market's reaction, that brutal sell-off, well, that suggests that somebody found a crack in the foundation. And our job today is to take out our tools, our instruments, and to really test the integrity of this whole structure. We need to see if those cracks are just superficial, cosmetic stuff, or if they run deep, right down to the core of the business model. We're here to decode these mixed signals and find out what's really built to last.
Exactly. Just look at this. You can see the two stories playing out right here, side by side. It's like two different worlds. In one corner, you've got the company's official narrative, stellar growth, and not just growth, but it's accelerating year over year. They put out strong guidance for what's coming next, and then, the cherry on top, they announce a massive $2 billion share buyback. That's management basically screaming from the rooftops that they think their own stock is a bargain. But then, you look at the other side, the market story. The stock sells off, and it sells off hard. Suddenly, all the whispers are about valuation fears, that this thing is priced for a level of perfection that it just didn't deliver, and all of a sudden, every single dollar of spending is under intense scrutiny. These are two completely different realities. Our job is to figure out which one is closer to the truth.
Okay, so let's start by forging the bull case. Before we go looking for those cracks, let's take a minute and just appreciate the structure itself. I'm going to lay out the hard, cold data that makes Shopify look like an absolutely unstoppable juggernaut in the world of e-commerce. Let's just forget the stock price for a minute. Let's focus on the fundamentals, on the raw financial power this business is actually generating. We're going to build this case piece by piece with numbers pulled straight from the filings. This is the fortress of financial strength.
Let's start with the absolute foundation, the top line. For the full year of 2025, Shopify brought in $11.6 billion in revenue. Just let that number sink in for a moment. This isn't some scrappy little startup anymore. This is a massive, enterprise-scale machine that has become a core, indispensable part of the global commerce infrastructure. This number alone, it tells you about the sheer scale they're operating at. It's the kind of revenue figure that demands respect and solidifies their position as a completely dominant force. Everything else we're about to talk about is built right on top of this.
Now, a big number is one thing. That's great, but is it growing? That's the next critical test. And the answer here is a resounding yes. Revenue grew 30% year over year. But here's the part that is absolutely critical to understand. This is an acceleration. In 2024, their growth was 26%. So in 2025, they didn't just grow, they added 4 full percentage points to their growth rate. Think about that. This is not a company that's slowing down as it gets bigger. No, it's hitting the gas. For a company of this scale to be accelerating its top-line growth, that is a powerful, powerful signal of market dominance and incredible execution. The engine isn't just running, it's running hotter and faster than it was a year ago.
Okay, so revenue is huge and it's accelerating. But what does that revenue actually represent? Well, it represents this. $378 billion in gross merchandise volume for the year. That's GMV. This is the total value of every single thing sold through their platform. You have to stop thinking of Shopify as just a software company. It's more like a digital nation with its own GDP. $378 billion. And that itself is up 29% from the year before. This isn't just about a few subscription fees. It's about the massive tectonic flow of global commerce running directly through their pipes. When you have this much volume, you are not just a player in the game, you are the game for millions and millions of merchants.
And this, for me, is where it gets really, really interesting. It's not just about paper revenue. It's about how much of that is turning into hard, cold cash. Look at this free cash flow chart. They went from $1.6 billion in FCF in 2024 to a full $2 billion in 2025. This isn't some accounting magic or spreadsheet trick. This is cash in the bank. After all the bills are paid and the investments are made, it's the absolute lifeblood of a company. It means they can fund their own growth, they can pour money into new technology, and they can return capital to shareholders, all without needing to borrow a single dime. This surge in cash generation, it shows a business model that is not only growing at a massive clip, but is also becoming incredibly efficient and profitable at its very core. This is a cash-generating fortress.
And you better believe management knows it. Just listen to what the company's president, Harley Finkelstein, had to say. He said, 2025 was Shopify at full throttle, driving compounding growth while laying the rails for the new era of AI commerce. Now, this isn't just some generic corporate speak. He's telling you two very specific things here. 1, the core business is firing on all cylinders. That's the full throttle part. 2, they are actively, deliberately building the foundation for the next decade of growth, and they're pointing right at AI. This quote frames their stellar performance not as some one-off good year, but as a deliberate, strategic execution of a much larger, long-term plan. They believe they see the future, and they're convinced they're building the tracks to get there first. And if you had even a shadow of a doubt about their confidence, well, they put their money where their mouth is. $2 billion. That is the size of the new share repurchase program the board just authorized. Now, let's be clear. A company does not authorize a buyback of this magnitude unless they believe two things with absolute unshakable conviction. First, that their business is going to continue to generate massive amounts of excess cash, and second, that their own stock is the single best possible investment for that cash. This is the ultimate insider signal. It's management looking at the market price after that big sell-off and basically saying, "You're all wrong. We'll take those shares off your hands." It is a massive $2 billion vote of confidence in their own future.
Okay. That is a very compelling case. I'll give you that. You've built a really solid-looking fortress here. The walls are high, the treasury is overflowing, but even the strongest fortress can have hidden weaknesses. A foundation can look perfectly solid from a distance, but you never really know its true strength until you apply some serious pressure. So now it's time to do exactly that. It's my turn to stress test this foundation. We're going to bring in the seismic equipment, and we're going to see if we can find the exact cracks that made the market so nervous. It's time for the skeptic's scrutiny.
And you know what? We find the first crack almost immediately. It's right here, on the Q4 bottom line. Yes, revenue was fantastic. They beat the analyst estimates by a solid 2.4%. Nobody's debating that. But look over to the right. Adjusted earnings per share, EPS, the actual profit they delivered to their shareholders. They missed expectations by nearly 6%. This is the paradox in a single slide. They sold more stuff than anyone expected, but they somehow made less profit doing it. For a company that carries a premium valuation, any kind of miss on the bottom line is a major, major red flag. It immediately makes you ask, what is the true cost of all this growth?
And this slide tells you exactly what that cost was. Let's drill right into the Q4 operating expenses. And we're looking at them here as a percentage of revenue. Sales and marketing, up a little bit. General and administrative, up a full percentage point. But look at the big one, research and development. R&D spending shot up by 3.4 percentage points compared to last year. It now eats up 13% of all revenue. This is the why behind that EPS miss. They are spending, and they are spending heavily, especially on building new tech. Now, while the bulls will call this investing in the future, the bears, and clearly the market on this particular day, they call it climbing costs that are eating into profitability right now. The spending is growing faster than the revenue, and that is a clear crack in the profitability armor. And all of that spending brings us to the elephant in the room, the valuation. Heading into this earnings report, Shopify was trading at an approximate price-to-earnings multiple of 80x. Let's be crystal clear about what that means. That is a stratosphere valuation. That is a price tag that demands not just excellence, but absolute, unequivocal perfection. There's zero room for error. When you are paying 80 times earnings for a stock, you expect flawless execution. So, when the company comes out and misses on EPS, even by a little bit, and shows that its costs are rising, the market's reaction is going to be brutal. That premium valuation is a double-edged sword. It reflects high hopes, but it also means any perceived stumble will be punished and punished severely. That EPS miss called the entire valuation thesis into question. And as if a miss on past performance wasn't bad enough, they decided to pour gasoline on the fire with their guidance for the future. Just look at the outlook they provided for the first quarter of 2026. Management is guiding their free cash flow margin to be in the low to mid-teens. Now, remember, they just posted a 19% margin in Q4 and 17% for the full year. So they are explicitly telling the market to expect a near-term slowdown in cash generation. Sure, they can talk about seasonality and some one-time tax payments, but what the market hears is our profitability is about to get weaker. For a stock that's priced at 80 times earnings, a guide down on a key profitability metric like that is the equivalent of yelling fire in a crowded theater. The sell-off was almost inevitable at that point.
I hear all those concerns. The spending is up, the near-term margin guidance is down, I get it. But this is the exact point where you have to decide if you're a trader just looking at the next 3 months, or if you're an investor looking at the next 10 years. I would argue that this increased spending isn't a sign of weakness or some loss of discipline. It is a calculated, deeply strategic investment in future dominance. They are deliberately sacrificing some short-term margin today to build the essential infrastructure for what they believe is the next tectonic shift in commerce. This isn't about the price of today's results, it's about paying the price of the future.
And what is that future exactly? Well, a huge piece of it is this concept right here, agentic commerce. This is what all that R&D spending is really about. We're quickly moving beyond an era where we, as humans, browse websites and click a buy button. We are entering a brand new era where AI agents, think of a much smarter Siri or Alexa, or agents integrated directly into things like ChatGPT, will discover and purchase products for us. Shopify is pouring money into building the foundational plumbing, what they call the Universal Commerce Protocol, to make sure that when an AI buys a product, that transaction still flows through their system. This is a massive, forward-looking bet that could completely redefine their entire market. But hold on, that sounds like a huge risk. The biggest fear, the existential threat, is that these incredibly powerful AI models, these large language models or LLMs, will just learn to bypass Shopify completely. They'll find the product and the merchant directly and just cut Shopify out of the loop, which would just destroy their merchant solutions business. And that is a legitimate threat. It would be if Shopify wasn't already meeting it head-on. Listen to Harley Finkelstein again. LLMs do not bypass Shopify's checkout. The back end of commerce will always flow through Shopify. He is making a direct, forceful statement to the market. He's saying, even if the discovery part of shopping happens on some new AI platform, the mission-critical back-end stuff, the checkout, the payments, the order management, the fraud protection, all of that will remain on Shopify's rails. They are positioning themselves to be the non-negotiable infrastructure no matter what the storefront of the future looks like.
And while they're building for that AI future, the investments they've already made are paying off big time in other high-growth areas. This isn't just some theoretical future payoff. Look at these numbers for the full year 2025. B2B GMV, that's businesses selling to other businesses on their platform, was up an incredible 96% year over year, almost doubled. Revenue from outside of North America, up 36%. And their offline revenue from their point-of-sale systems in physical stores grew 27%. These are powerful secondary growth engines that are already firing on all cylinders, diversifying their business away from just being about direct-to-consumer online stores. The investment is already yielding very real, very concrete results.
And this vision, it's also attracting the biggest players in the world. This is not just about small entrepreneurs with a dream anymore. In 2025, major enterprise brands like General Motors, L'Oreal, Starbucks, Coach, and Michael Kors all signed on to the Shopify platform. I mean, these are titans of industry. These are companies that have the resources to build any system they could possibly want, and they are choosing Shopify. This is the ultimate form of social proof. It demonstrates that the world's most sophisticated and demanding brands are buying into Shopify's vision, and they believe that their platform is the best possible foundation for the future of commerce, both online and off. All right, we've laid it all out on the table. The bull case stands on a foundation of massive, accelerating growth and truly powerful cash generation. The bear case points to some very real cracks, that EPS miss, the rising costs, and a valuation that leaves absolutely no room for error. So it all comes down to the final verdict. What do you do with this information? Is this sell-off a golden opportunity to buy a best-in-class company at a discount, or is it a huge warning sign that the stock is just fundamentally overpriced? It is time for the iron verdict. So let's weigh the metal right here. On the bull side, the fortress. You have dominant, accelerating revenue and GMV growth. That's undeniable. You have powerful, growing free cash flow generation. You have multiple new growth levers that are already firing, from B2B and international to the massive future potential of AI. And on top of it all, you have a $2 billion buyback that signals extreme confidence from management. It's a heavy, solid case. But on the bear side, the cracks are just as clear. They missed profit expectations, which is a cardinal sin for a high multiple stock.
Operating expenses are rising faster than revenue, which is pressuring margins. They guided down on near-term free cash flow. And all of this is happening against the backdrop of an extremely high PE valuation that demands nothing short of perfection. You absolutely cannot ignore these risks.
So here is our verdict. Fundamentally, Shopify is a structurally sound company. The business itself is a fortress, and it's being built for the future of commerce. Their market position is dominant, their growth is very real, and their strategic vision for AI is compelling. There is no question about the quality of the underlying asset. But, and this is a huge but, it is an asset that is priced for that perfection today. The current stock price already bakes in a decade of flawless execution. The sell-off wasn't the market saying Shopify is a bad company. It was the market saying that at an 80 times PE multiple, a slight miss on EPS and weaker guidance simply isn't good enough. The risk here isn't really in the business. The risk is in the valuation. You're paying a premium price that leaves absolutely no margin for safety.
And that leaves you with the final, crucial question you have to answer for yourself. Is Shopify a fortress that is worth paying a premium for because you believe that its long-term growth will more than justify today's price? Or is it a gilded trap, a fantastic company whose stock has just gotten too far ahead of its fundamentals, setting investors up for potential disappointment if execution isn't absolutely perfect from this moment on? That's the question you have to answer before you put your capital to work. That's your deep dive. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.